Hello and welcome to our discussion on accounting. The focus of this session is to understand some important terms in accounting, and the term that we will be discussing today is the zero coupon bonds and accounting for ZCBs. But before we get into the accounting for ZCB, let us understand what are these zero coupon bonds. A zero coupon bond is also called a deep discount bond. It is a debt instrument issued at a price lower than its face value but redeemable at the face value at the time of the maturity date and the maturity date. So the difference between the issue price and the face value is treated as the discount. So zero coupon bond is another type of a debt instrument, but there is no interest paid over the period or during the life of the bond. Let us take an example. If A Limited issues 1000 zero coupon bonds of 100 at 62 in 2013, redeemable at par at the end of the 5th year. So 1000 zero coupon bonds of 100 at 62. So let us see, the cash received is 62,000, but the bond value is 100,000 redeemable value. So the discount is 38,000. According to the Schedule 6 of the Companies Act, the discount 38,000 is shown on the asset side and it has to be amortized over the bond period. Let us take an example and see the financial statements. Suppose the opening balance sheet is given and some transactions are given. Our focus is on this issue of Z zero coupon bonds. So let us complete the working note for the zero coupon bond. The face value of the bond is 100. The number of bonds issued is 1000. So the face value of the bonds issued is equal to 100,000. But the price at which the bonds are issued is 62. So cash received or cash collected at the time of issue is 62,000 and the bond discount is 38,000. So when the company issues this bond, cash received is to the extent of 62,000 is 62,000. But the bond will be shown, at 100,000. The bond will be shown at 100,000 face value of the bond, and the discount will be shown at the bond discount. We call that on the asset side. We can also show that on the sources side as a negative premium, but let us stick to the Schedule 6 of the Companies Act. So we can see that cash has increased by 62,000. The bond is shown at the face value and discount of 38,000. Let us complete the other transaction. The sales during the period is 900,000, sold entire stock. Let us assume that it is for cash. So entire sales is for cash, and the corresponding cost of goods sold is equal to 750,000, and the stock will become zero. The operating expense OPEX is equal to, the operating expense is equal to 65,000, and let us assume that we paid that operating expense fully, 65,000. interest on the loan to be paid to the extent of 12%, 0.12, and let us assume that we pay the interest for that period. So if all transactions are done, now let us follow the Companies Act and amortize this bond discount over a period of 5 years. So bond discount amortization is 38,000 divided by 5, and to that extent the bond discount will reduce in the balance sheet. So we can see that bond value or the bond discount was 38,000 to the extent of 7,600. Let us sum this up. So we will get the PBT, and PBT is equal to income minus expenses, and tax is equal to, as usual, we are assuming the tax is calculated on the PBT at 30%, and let us assume that the tax has been paid. So 14,220, and this is PAT. If no information given, we will take the entire PAT to be retained. So entire PAT is transferred to the reserves. Entire PAT is transferred to the reserves. Okay, and we'll find the cash in hand, cash available, minus the cash payments. So is a cash in hand is equal to cash available minus cash payments, and cash will be shown on the balance sheet as an asset. No change in the debtors, no change in the loan, no change in the creditor, and no change in the capital. So a balance sheet tallies. Let us observe the treatment of ZCB once again. So ZCB will be shown at the face value, and cash collected will be shown as a receipt, and the bond discount will be amortized over the bond life, in this case over a period of 5 years. So for next 5 years, for the next 4 years, every year 7,600 will be shown in the income statement, and the bond discount will keep on reducing, and at the end it will become 0, because the entire bond will be bond discount has been amortized. So according to the Companies Act, so the discount is shown on the asset side and is amortized over a period of the bond life, and the bonds will be shown on the balance sheet as a liability of 100,000, and on the due date when the cash is paid, the bond will reduce and cash will reduce to that extent. Thank you.